Welcome back to the Financial Autonomy Podcast. My name's Paul Benson, financial planner and practice principal at Guidance Financial Services. There's a lot of talk at the moment about whether stock markets around the world are in a bubble. Most of this talk focuses around AI, something Nick and I discussed in a Wealth Builder episode just last week. If you've given that one a listen, you'll know that my best guess is that we aren't in an AI bubble just yet, though that doesn't preclude us getting there at some point in the future. Statistically, markets have a negative year about 1 in every 4. There's therefore an inevitability about a downturn, and as investors, we've just got to be comfortable with that, recognising that 3 out of 4 years, markets go up. With no intention of endeavouring to sidestep a downturn or outthink the market, taking a guess as to what might be the catalyst for the next fall can be an interesting theoretical exercise. And that's what's led me to the selection of this week's topic. You see, if I was to place a bet on what would cause the next market pullback, it wouldn't be AI, though I'm sure there'd be companies in that pool that will drop significantly. But I don't think that's what will cause the fall in the first place. To me, it seems far more likely that private credit is where the cancer will emanate from. I'm less concerned about private equity, but you can't rule this one out as being the foundation either. These two sectors of financial markets aren't particularly well understood. Indeed, that's part of why I think they're more likely candidates as the cause of a correction. In today's episode, I thought I'd take you through what these two investment arenas are all about so that you know where the risks lie in our markets today. Let's dive in. Okay, so let's start with what is private equity. So private equity refers to investing in companies that are not listed on the stock exchange. A private equity manager raises money from investors and uses that pool of capital to buy, improve, and eventually sell businesses. Think of private equity as buying a business, fixing it up, helping it grow, and then usually selling it for more than it paid. There are some private equity players that just buy and hold forever, but typically they're looking to flip it. So look, how does it work? So they raise capital, right? And typically that's from your big super funds and your institutions, and the raise will be for a set period of time. They'll then go out and use that capital to buy companies that have potential but may need operational improvement, perhaps better management, or maybe they just need extra capital in order to grow. So then the manager is trying to enhance the value, right? They're trying to improve profitability. Maybe they expand into new markets, upgrade systems, optimize the capital structure, or facilitate mergers or bolt-on acquisitions. And then at some point down the road, usually somewhere in the 5 to 10 year mark, they're looking to exit. The business is sold, and of course, hopefully sold for more than what they've put in, and then the private equity manager can then give money back to the original investors. So the appeal of private equity, for one, when it goes well, there is potential for good long-term returns. There's an ability to get in there and have some influence, not so much for investors, but as the manager. But the primary benefit is diversification. So because returns aren't tied to the stock market, because the investments just aren't listed on the stock market, returns are, appropriately diversified. Now, there is a limit to that insofar as a lot of the private equity plays, their ultimate exit is to list on the stock market. And of course, if the stock market's in the doldrums, then it's not so easy for them to list and exit. So it does have some interaction with the stock market at the end, at the point of exit, not always, but often. So it's not totally, decoupled from that. In Australia, it's mainly super funds that participate in this space, because it is more of an institutional area that requires the ability to write some pretty large checks. Now, the risks around private equity, the main one is illiquidity. So once you put your money in, you're tied up in that business for a long period of time, or that fund for a long period of time. So it's certainly not like shares listed on the stock market where you can sell them and have your money 3 days later. There's certainly complexity here. So investors need to be able to have a good look at who the management are and actually have they got the ability to improve these businesses and to execute appropriately. There's higher costs because it is a very active process. The private equity managers certainly know how to charge. And of course, there's valuation uncertainty, and that's an interesting element in terms of our super funds, because these private equity funds, you really don't know the value of these businesses till the end, until the point where they exit. So how do you value those businesses along the journey? And they certainly do, because you need to know what the value of your super fund is, and so valuations are estimated, but they're a bit rubbery really until there's an exit point. Perhaps an example, if just in an Australian context, Virgin, the airline, that was acquired by the private equity firm Bain Capital in 2020 when it collapsed during the COVID pandemic. And it's expected that they will relist that business on the ASX sometime soon. Okay, so that's private equity. The other, element to today's post is private credit. So while private equity involves owning a business, private credit involves lending money to businesses where they're not borrowing through traditional banks or issuing bonds. So private credit is being the lender when a business needs funds to expand or acquire or maybe just for cash flow purposes, but they're not able to get that from a bank, or maybe they're just after a bit more flexible arrangements than what a bank would give. Now, in Australia, and in fact it's reasonably global, it's certainly a phenomenon in the US as well, banks have become more conservative in their lending due to regulatory requirements around how much capital they've got to hold. And so that's created a bit of an opening in the mid-market, small-cap kind of space for companies that can't source the type of funding that they need from banks, and therefore they're looking for someone else to help them out, and that's where the private credit providers step in. So these sort of loans, often they're at a bit higher interest rate. They've got tighter covenants, so tighter conditions around how the loans work and what would trigger a default, and quite bespoke terms. So, real customised lending solution for a business, maybe far more so than what a bank would provide. It means that potentially there's higher returns for investors as a consequence of that higher interest rate. But of course, there is also higher risk, right? Again, these are loans that the banks wouldn't write. And so that tells you that, they're of a higher level of risk. So in terms of the benefits of investing in private credit, mainly it's just that higher level of income. Interest rates are usually floating, so you don't sort of get stuck on a fixed rate if rates move up. There's a diversification benefit there, right? Because you're a quasi-bank, right? So your return is just getting an interest rate return as loans get repaid. You're not in the ups and downs with the share market. And therefore there's not the correlation there, which is all part of the diversification piece. But on the risks, I guess to a similar extent to private equity, illiquidity is the main one. So you can't easily get your money back. I mean, if you've contributed into a fund and the fund's then lent that all out to businesses on 5-year, 7-year, 10-year terms, then you can't just say, oh, well, I want my money back, because, the businesses have gone out and used that money to do things and they've got to make their repayments. So when you put money in one of these private credit funds, as per the private equity funds, your money's tied up for usually sort of at least 5 years, but often more like 10. The other risk is that the businesses that you lend to aren't able to pay you the money back, or pay the fund back, at least assuming that you go through a fund, which is the more probable route. And that's a very real risk. You're dependent very much on the manager to do the credit assessment and make good decisions on who they lend money to and on what conditions. And there's certainly less transparency when it comes to private credit, because they're not in the public markets. There's not a lot of scrutiny. So private equity, private credit, why are they why have they become more popular over recent times? So there's a few reasons. More companies are choosing not to list on public stock markets, and so they're using private equity as a way to raise capital without having to do the stock market listing, or perhaps private credit to do the same thing, borrow instead. Now, they're perhaps not going on public markets because of the scrutiny and needing to do regular reporting and constant disclosures and some of these sort of things. It's to some extent maybe intrusive, particularly for businesses that are growing rapidly and maybe aren't posting much profit because they're just pumping everything back into their business. So I guess the biggest example here in Australia would be Canva, the design business that a lot of people use their software. But for the moment, at least, they're still private. They haven't listed on the stock market yet. Another attraction is just people chasing higher returns. But of course, you've always got to keep in mind that higher returns means there's higher risk, right? They're very much related. But nevertheless, people are chasing a higher return and potentially accepting of a little bit higher risk, especially things like the big super funds where, given that the primary risk with these is illiquidity, well, they've got pretty sure money because they've got pretty good visibility on how much money comes in every month. They know how much pensions they have to pay out. That amount's probably going to increase as the pool of superannuants gets older and retires, but nevertheless, it's reasonably forecastable how much money they need to pay out. And so having some proportion of the portfolio, a relatively small proportion, tied up such that they can't access it for 7 or 10 years, that's quite acceptable to them, so long as the return at the end is a positive one. There's also, in terms of private credit especially, it's become popular because the banks have sort of vacated some of this space, and so it's just created an opportunity there. All right, so look, at the top I said that my guess for the catalyst for the next market correction would be private credit. So my thinking here is that this lending it's the more aggressive type, right? It's the loans that the banks won't touch. Now, that works well when the economy's growing, as we've seen both in Australia and in the US for many years now. But if the economy slowed, and especially if we entered a recession, then that's the sector that will feel it the most. Those mid and small cap companies who've borrowed too aggressively. We saw it in the 90s when Westpac got into a bit of strife, and we saw it in the GFC too. History doesn't repeat, but it rhymes. That's not my quote, but it has application here, right? History doesn't repeat, but it rhymes. All right, look, I'll leave you with it. As always, these are general thoughts. It's not, I don't know your portfolio, so certainly don't interpret this as recommendations. But hopefully you're a little bit more informed about a couple of elements of the market that maybe aren't so well understood. All right, thanks for listening. Back next time. Bye-bye.